Hello everyone, this is a recording of a presentation that Kpler Insights did for its APPEC event on the 26th of September. We're going to be looking at the gas and LNG outlooks. My name is Laura Page and I'm Senior LNG Analyst at Kpler Insight. After this presentation, we're going to be talking with Matthew Boyle about the outlook for the coal markets. So starting off with gas and LNG, let's have a look at our LNG supply expectations for this winter. So last winter, we saw LNG supply coming in at around 200 million tonnes. And this winter, we expect between 5 and 6% growth, which will bring total LNG supply to nearly 212 million tonnes. Now, as I'll explain in the next slide, the growth mainly comes from the United States and from Norway. But in general, we do expect liquefaction plants to really push their utilisation rates this winter due to continued record high LNG prices that we've been seeing in Europe and in Asia in recent months. Now, in terms of capacity growth this winter, it's really limited to the ramp up of Russia's 1.5 MTPA port-to-via LNG plant in the Baltic Sea. And we also will see Mozambique start up its first ever LNG terminal, the 3.4 MTPA Coral South FLNG. So diving into this production forecast a little bit deeper, you can see from the first chart on the right that we expect over 3 million tonnes of additional production from the US this winter and 2.3 million tonnes from Norway. Now, the US has brought online the Sabine Pass Train 6 and Calcasieu Pass plants in the past year, and this accounts for an additional 15 MTPA of capacity. But we do think that US production growth is going to be limited by an outage that occurred at Freeport LNG this summer. So the 15 MTPA Freeport facility is currently offline and it has been since June. And we expect that this could partially restart in the first half of November. Now, as you can see from the chart on the bottom, this is weighing on our LNG supply expectations for the US this winter. Outside of the US, we also have production growth from Norway this winter due to the restart of the country's Snøhvit plant after a fire happened there in September 2020. We also expect potentially higher deliveries out of Qatar, and this really depends on their maintenance patterns in Q1. And potentially higher production from Trinidad and Tobago as well, due to higher feed gas deliveries there. And as I said previously, Mozambique is expected to start up its first LNG supply project at Coral South. There have been some technical issues at the plant recently, but we do expect that they could produce their first cargo in October and export 0.6 MTPA this winter. So with that view on supply, let's turn our attention to how demand for LNG could look this winter. Now, we expect Northeast Asia, so the likes of Japan, South Korea, China and Taiwan to continue to pare back their LNG demand this winter. This is due to switching to cheaper alternative generating fuels and also weaker economic growth in China, which continue to drive the downside. We expect that Chinese economic growth could remain slow this winter and for the country to continue to look inwards for domestic gas and coal, as well as ramp up cheaper pipeline supplies from the likes of Russia, and that could continue to weigh on LNG demand expectations this winter. Now, what this means for the market is that if we have weaker demand in Northeast Asia and potentially weaker demand in South Asia as well, this will free up more supply for Europe, which is facing the prospect of Russian pipeline gas supplies being completely cut off this winter. We see the biggest risk on the demand side being colder than normal temperatures in Northeast Asia. This will continue to drive demand for heating and potentially pull cargoes away from Europe. Now, there is quite a high probability of La Nina being in force in Q4, and this can bring around below average temperatures, but that probability subsides around the turn of the year. So there's lots of uncertainties on the demand side related to temperatures. Turning a little bit closer to Europe, we've seen many LNG import terminals facing very high utilisation rates and bottlenecks recently. We will see several new FSRUs coming online over the next couple of months to alleviate import bottlenecks. We've already seen a new terminal coming online in the Netherlands in September. This is formed of 2 FSRUs and have the capacity to import 5.9 MTPA of LNG. And we do expect to see potentially 3 German LNG imports terminals coming online. And this means that Germany can start for the first time importing LNG. So this will allow Germany to really continue its diversification programme away from Russian gas, because Germany is very reliant on Russian gas up until now. Elsewhere outside of Germany and the Netherlands, we do see an FSRU starting up in Finland and Estonia as well. They will share this FSRU with the capacity to import 3.7 MTPA, and we expect this to come online around the turn of the year. Now, one thing that the market is really going to be paying close attention to this winter is the drawdown of Europe's underground gas storages, given the environment of low Russian pipeline gas supplies. There are lots of uncertainties that will influence the rate of drawdown. This includes the level of Russian pipeline gas flow this winter, demand destruction, LNG arrivals, and of course how temperatures will outturn. So around half of Europe's gas consumption in the winter is from heating. So the colder the temperatures, the faster the drawdown of stocks this winter. Now, in this slide, we have looked at 3 storage scenarios which could potentially play out this winter, changing a key variable that is hard to predict, and that's the temperatures. Now, we see storages ending winter at the end of March around between 20% and 50% of capacity, and this depends on the temperatures. Now, for all these 3 cases, we have the following assumptions. The first assumption is that we assume no Russian gas is flowing to Europe through the Nord Stream 1 and the Yamal pipelines. However, we do assume that gas will continue to flow through Ukraine and the Turk Stream pipelines. The second assumption is that European domestic gas production is estimated to be around 361 BCM this winter. The third assumption is that we expect Europe to import 85 BCM of pipeline gas from Norway, Algeria, and Azerbaijan. And the last assumption is that we expect Europe to import 66 million tonnes of LNG. So with this all in mind, how does this impact prices over the next couple of months and through the winter period? Well, assuming an average winter temperature-wise, we do expect TTF prices to average $64 per MMBTU this winter, and JKM prices to average $53 per MMBTU this winter. Now, given this assumption, we do expect that European prices will maintain a premium over Asia during the winter period, given higher demand for LNG, and that's caused by the lack of Russian pipeline gas into the region. Potential risks here are to the upside, particularly if it's a colder than normal temperatures hitting Northeast Asia, and then end users returning to the spot market, which could draw cargoes away from Europe and see that price competition between Europe and Asia reignite. Now, just looking at the US quickly, domestic gas production there is expected to continue to rise, and LNG feed gas demand will pick up in November when Freeport LNG is expected to restart. We expect that US domestic gas storages will, however, remain below average, which will support higher Henry Hub prices. And we see prices averaging just below the $10 per MMBtu mark this winter. So that's the outlook for gas and LNG. I'm now going to move over to Matthew Boyle, who looks at the coal markets. Over to you, Matt.
Thanks, Laura, and hello all. The role that coal has played, in particular in some markets, I'm sort of looking more at Europe, is actually becoming more and more important. So the role that coal plays as part of the overall energy complex is becoming paramount. In Asia, it is less influenced by the fuel switching that you will see in Europe and the US, but the dynamics are still very important, especially as in Asia, coal is the overwhelming fuel of choice in all markets. So next slide, please. So before I sort of go into just Asia in general, I thought I would just look at thermal coal import demand. And so this is an aggregated view of the key demand markets. The European numbers there are slightly inflated due to some intra-European flows, but the overall trend is sort of showing is consistent. So China and Japan, Korea and Taiwan are in the lower bands. Then you have Europe, which is somewhat inflated at the moment, and the final two are India and Southeast Asia. So geopolitics has really impacted, sort of what we call in the coal space that substitute fuel market. So in this case, it's LNG and gas supply. So that has boosted thermal fuel prices. Spot-focused demand markets have been more impacted by the rising spot coal prices than the cheaper long-term supply contracts. The Asian spot coal market is concentrated in China, India, and Southeast Asia. And these regions contribute the most to the decline in our forecast. In the Northeast Asian market, you tend to be sort of somewhat more reliant on longer term contract prices. So it's almost like you have a divide, so sort of splitting Asia into two, where the markets in a high spot price, coal price environment are being impacted, and it's resulting in import demand destruction. The high gas and LNG prices in Europe are keeping coal generation in the money, so that is maintaining higher coal import demand into 2023 compared to sort of what we have seen this year and last year. The pullback of Russian coal supply, it's important to know that with this sort of 60 million tonnes or so of total Russian sort of coal supply that has been removed from the seaborne market, it cannot be made up by other regions. So this will also help support higher spot coal prices through 2023. If we could go to the next slide, please. So the war between Russia and Ukraine has seen additional dislocation of the more popular trade flows that are in the seaborne market. So buyers in Europe have had to switch to alternative supply to sort of meet their import requirements. And in some cases, this has been somewhat surprising. So to illustrate this, I've taken the example of Poland and their coal imports. Why Poland? Polish coal imports have jumped this year as the country was once very dependent on Russia for its coal, but it has now switched to other markets. Poland also has its own domestic coal market. So they are actively seeking substitution for the Russian coal that they were somewhat reliant on previously. So you can see here that at the start of the war, Poland had stopped taking Russian coal and had resumed higher Australian coal imports. It had also taken more US, South African and Colombian coal, but for simplicity of this chart, I've decided to just show Russian coal and Australian coal into Poland. Although the volumes are just a couple of Panamaxes a month, what makes this trade so unusual is the large front haul freight component, which usually makes Australian coal uneconomical to flow to Europe, so let alone Poland, which is further than the ARA ports. It actually has to go past the ARA ports to then go to Poland. What is happening in Poland is actually similar to what is happening in some of the other European markets, such as Spain and Portugal and Italy as well. I'll talk a little bit more about Russian coal exports a little bit later, but if we could move to the next slide, please. Again, I'm sort of now switching back to Asia, and I want to talk about China in particular, because China is the largest seaborne thermal coal import market. The current seaborne thermal coal market is just under 1 billion tonnes per year. China has imported somewhere between 180 to 250 million tonnes of seaborne thermal coal over the past 5 years. In 2021, China imported around 313 million tonnes of coal. Now, the country has a coal import quota of around 300 million tonnes, so of which historically it's been 1/3 for met coal imports used in steel making, and 2/3 is thermal coal used in power generation as well as other industry and cement making. That in 2021, that split was closer to a 25-75% split to thermal coal. In 2021, there were domestic supply disruptions and weather-related demand spikes. So China's NDRC implemented policies to promote coal production and improve coal supply availability for the utilities. And what this has done, it's really pushed coal production to record levels. All coal-producing regions, except for the coastal provinces in 2022, have recorded year-on-year growth. Even the coastal provincial year-on-year growth is just below 2021 levels at sort of -1% year-on-year. So the big push in China's coal production remains out in the western provinces, and this will continue to increase in 2023. As an example, August's raw coal production at 370 million tonnes was 3 million tonnes lower than our Kpler Insight forecast. So Chinese raw coal production is inching that much closer to that elusive 400 million tonne per month level. Current year to date, raw coal production is about 2.9 billion tonnes, and our forecast for 2022 is almost 4.5 billion tonnes. So to put this another way, year to date production for the January to August period is almost the equivalent of an extra month of output, or the equivalent of January to September 2021 levels. This is the equivalent to almost 40% of seaborne thermal trade, annual seaborne thermal trade, each month. So yeah, China is such a dominant player in the obviously domestic market, but also in the seaborne market as well. There has been a lot of noise about COVID lockdowns and logistics, but we do not see this as an issue. In fact, we believe that Chinese coal logistics remain unconstrained, and any news about delays or disruptions is only short-term in nature. So we maintain a bullish outlook for Chinese coal production, and it is set to continue to climb in 2023. Next slide, please. So looking at the Chinese domestic production, we obviously need to have a view on sort of seaborne coal imports into China. And because of the higher domestic production, we are somewhat bearish compared to previous years. So we believe that COVID lockdowns and the slowing economy will hamper industrial production. This will also include crude steel output, which will have a knock-on effect on the metallurgical coal market. But ultimately, the higher domestic coal output and the higher seaborne prices compared to domestic prices will somewhat negate the requirement or need for seaborne imports. So we believe that 2022 could be the first year China does not take its full coal import quota. And this is just another step in China's movement towards self-sufficiency in coal, which we expect to continue in 2023. Next slide, please. So if we've had a look at demand, so let's check out supply. So given the high spot price environment, there has been some discussion as to why coal supply has not really increased. There are a number of factors for this. So first, gaining funding for brownfield expansions or for new projects is limited for coal. The financial institutions will not invest in new coal supply or coal-fired power plants due to ESG reasons. This has made the supply pipeline for new coal supply extremely limited. Second, coal producers have reduced their exposure to the spot market, and they have also matched their production to long-term contracts. So this means that buyers are not paying this headline spot price that is quoted, by some of the sort of industry press. And similar to long-term LNG and gas contracts, coal buyers are actually paying lower prices. So this chart here also shows Russian coal exports, which is shown in the green there, or the third band from the bottom, or the fourth from the top, depending upon which way you want to look at it. So we had stronger growth in Russian coal exports before the sanctions were implemented August 10. On the 19th of September, the EU clarified its sanctions stance on Russian coal and allowed for the transit of Russian coal to non-EU countries for energy insecurity reasons. So we believe that this could see higher Russian exports for Q4 than what is shown on this chart. Now, the Russian President, Vladimir Putin, has not changed his stance on banning Russian energy exports from the end of this year. So there is still some risk to for Russian exports from 2023 onwards. In any case, our clients will receive an update of the Coal Monthly Insights report, which we publish monthly. Next slide, please. So this is probably a good segue to sort of move into prices. So this was something I touched upon a little bit earlier, but I just want to reiterate the difference between spot and long-term prices for thermal coal and LNG. So we actually have both thermal coal and LNG here. There's quite a lot of shades of blue here, but to try and make it easier, the darker colors are LNG, and the lighter colors, including the orange, are coal. Maybe some of the gas crowd may argue it should be the other way around, but it's nice to sort of switch it up a bit. So the cheaper LNG and coal prices in 2021, together with Chinese domestic supply disruptions, as well as weather-related demand spikes, saw China become the largest LNG importer, and spot thermal fuel prices began to rise. And the conflict and the geopolitical tensions this year have further pushed spot thermal prices higher, the thermal fuel prices higher. Asian buyers of LNG and thermal coal are almost split between the long-term contract, in the case of Northeast Asia, or relying on the spot market, such as China and India and Southeast Asia. So I admit this is a generalization, but it just highlights the trends in the market. So we've seen a widening gap between spot LNG and long-term oil index price levels. This gap is less evident in coal, however. The higher prices are not seeing an increase in seaborne coal supply. As I mentioned, the producers are matching coal production to longer-term contracts. There are also difficulties in getting the finance. So it means that coal producers are currently pocketing revenue for OPEX purposes. And if they have enough of it in the current market, they may have that chance. Maybe they can sort of look at that for potential CapEx opportunities as well. The orange line here, I've used the reported $375 per tonne settlement for thermal coal between Glencore and Nippon Steel as the basis for the current Japanese fiscal year starting in April. I don't know if it's being widely accepted, but it appears to be the case. But if you can sort of see where Newcastle high CV prices are, the large year-on-year jump in prices is probably looking like fair value given that long-term price. In any case, on a spot basis, coal continues to remain cheaper than LNG gas in Asia, spot LNG and gas in Asia. Next slide, please. And this is my final slide. So, we're now going to sort of look at our thermal coal price forecast. And you can see FOB Australian prices remain stubbornly high. And this is partially due to the tight Australian spot coal supply. The higher Australian coal price, though, also incentivizes supply from South Africa and other supply regions to flow into Europe and into some of these demand markets. So we have seen a decline in South African coal prices, and that has also seen a subsequent increase in exports. Interestingly enough, that has been, most of those exports have sort of flowed back into Europe. The last 5 or so years, South African exports mainly would flow into India, the subcontinent, as well as Asia. But because of the sort of the demand pull from the European market, it is pulling South African coal flows into Europe. So the fall in spot coal prices, in this case in South Africa, has resulted in an increase in exports as buyers begin buying again. We believe current spot prices are above where market fundamentals should suggest them to be. And so we do expect this to decline in 2023 as we move into 2024. Prices, however, will remain above historical norms due to the lack of thermal coal supply pipeline and producers continuing to match production to their term contracts rather than supply into the spot market. And on that note, that actually brings us to the end of our presentation on LNG, gas and coal. And thank you very much for your time.